and welcome to this very special episode, earnings preview, and with me, Aisha Faridi, and on ET Now. Now, it's an interesting landscape that we're setting, or rather stepping into this earnings season with the gut-wrenching across-the-board fall in the markets of late. The recent macro risk are only raising risk to further earnings recovery. Add to that a reduced impact of a favorable base as well this time. No wonder then most on the street are cagey about what Q2 has in store for us. My guest on the show today, Suhas Harinarayan, Head Institutional Equity Research, JM Financial Institutional Securities, Gautam Dugar, Head of Research at Motilal Oswal Securities, and Naveen Kulkarni, Head of Research at Reliance Securities, joins us on the show right now. I also have with me our two researchers, Pankaj and Ajay, to really set the tone for this earnings season. And Pankaj, if I could start with you first, put the landscape into perspective as to what is it that we could be staring at, what D Street is expecting from earnings this time sectorally.
Well, Q2 earnings will be in focus very soon, and if you look at the sales numbers, they are expected to be in line with Q1 growth. However, PAT may take a decent amount of hit. Remember, between now and the previous quarter, you've seen a huge rise as far as input costs are concerned, whether you talk about crude, whether you talk about some of the base metals, whether you talk about overall cost of doing business increasing, so that will have an impact. Also, this will be a quarter where you will see the first impact where GST to GST, there will be a base impact which will come in on the companies, and that's why it will be an interesting quarter to look at the YOY growth numbers, especially for some of the domestic companies that get impacted by the GST implementation. Overall, autos are expected to be weak. Festive season is important for them, but it's a delayed festive season this time around, so that base effect will have a number. Plus, there was the GST numbers which also impacted the growth, so that will have an impact on the overall Q2 numbers coming into this quarters. Rupee has gone ahead and declined and is almost at an all-time low, so that is something which will be a tailwind for margins for a lot of sectors that do have exports within their basket. In terms of FY19, downgrade risk continues to be there. That's what most of the analysts are pointing out too. For sector-wise, IT will get a rupee tailwind. Pharma should be interesting considering what's happening into US and the rupee tailwind. And steel as a sector is expected to do well. In terms of sectors that are expected to show weak numbers, auto definitely for one. Select FMCG names are expected to not do particularly that great, and also PSU banking space should be very, very interesting. NBFC management commentary will be very important considering what's happened in the last 20-25 days.
Okay, Pankaj, thanks for highlighting what to expect from various sectors. And let's kickstart the discussion with our three wise men this evening. Gautam, if I could start off with you first. Let's pick it up on autos. You think a delayed festive season is going to impact volumes? And again, within autos, it's turning out to be such a diversified story, be it Eicher on one end, what's with Tata Motors and the concerns around JLR, and Maruti being available so cheap now. Okay, we seem to have snapped that line with Gautam. I'm just going to get to him in just a bit. But Naveen, if I could pose the same question to you when it comes to autos, what is it that you're expecting?
So, auto as a sector, we are not expecting great numbers because two of the biggest companies, Tata Motors and Maruti, are not going to report great numbers. Tata Motors is more likely to report a significant loss in this quarter, and Maruti, we are expecting their profitability to decline by around 25% in this quarter on a year-on-year basis. Reason being, both the companies are seeing significant pressure on margins. So that's the case for these two bigger companies. Ashok Leyland, we are expecting decent numbers because the CV volumes have been very, very strong. Overall growth numbers are around 22% for Ashok Leyland in terms of volume. So that's a very strong set of numbers. So that will lead to operating leverage benefits. They have passed on some bit of cost through pricing actions. In the two-wheeler space, Bajaj Autos should report decent numbers. Hero will see some bit of pressure on margins. Escorts, we are expecting them to report good numbers. M&M, we are expecting some bit of pressure on the margins. Also, tractor volumes were not that great. So overall, it's going to be a mixed bag, but the bias is slightly towards the negative side at this point in time.
Fair point. Well, come tomorrow and we'll be all eyes for TCS's numbers. Now, in a seasonally strong quarter this time, the big question is, will tech companies show better sequential acceleration in growth than what they posted in the first quarter, coupled with positive surprise in margins? So, Oz, what is your sense? Improving demand, bigger deal closures, rupee depreciation, they've led to EPS upgrades so far, but is there scope for further re-rating, or is investor optimism, would you say, mostly priced in?
From what we've seen, most of the upgrades have come in primarily on account of currency. We've seen very little upgrades for the IT companies, save maybe some mid-cap companies in the past, and maybe at best maybe a large cap, but we really haven't seen significant earnings upgrade, basically constant currency or a dollar revenue upgrade. We've seen rupee EPS and revenue upgrades mainly because of the depreciation in currency. In fact, just recently we recommended investors to start looking to go underweight IT because we're still not seeing upgrades on across the board on a sector-wide upgrades to the constant currency or the dollar revenue numbers. So yeah, I think numbers sequentially should be better because, as you mentioned, it is one of the stronger quarters before you head into 3Q, which is one of the weaker quarters. So clearly numbers will be sequentially better. So you could take a call whether you want to wait until the quarter to end before looking to trim. We are not saying exit IT. We are just saying maybe the sector has done very well, possibly and as I said we are not seeing upgrades on the constant currency. From that perspective, maybe you should look to trim some, is what we've been recommending on IT.
Okay, Gautam as well joins in back. And Gautam, since we have TCS coming up with its numbers tomorrow, the same question that I was asking Naveen as well right now, and Suhas, how much more do you think is the scope for investor optimism? I mean, how much more can TCS grow than what the stock price is already pricing in?
Hi Aisha. So on TCS particularly, valuations are clearly reflecting the numbers based optimism. However, what can still continue the momentum is the fear in the market. The IT companies are not rallying because there is a significant earnings upgrade. The IT companies are rallying because there is a fear in the market, and it is being used as a defense because consumer stocks trade at 40-45 times. Pharma, there is no earnings growth. And the only sizable sector which is then left is IT. So while we can debate on the logic and rationale for valuations of a lot of these IT names, what I think is right now it's a kind of a cash trade for a lot of people. Plus, one also has to remember that many of the large cap IT companies in the last 15 or 18 months have returned substantial amount of capital back, and you have seen some uptick in growth. And at the same time, we are into a quarter which is seasonally one of the strongest quarter for the IT sector. So combination of all of these factors is driving the IT stock higher. Who's to say it cannot go up another 5-10%? Fundamentally, obviously at 23-24 times, it does not justify. There are still some stocks within IT sector where there is value, likes of Infosys, likes of Tech Mahindra. There is still enough value even in HCL Tech. But tier 2 IT obviously is trading at a substantial premium to large cap IT. I would not be very gung-ho on tier 2 IT. But at the moment, I think it's not just about IT earnings and IT EPS. It's more about what is happening in the broader market, which is also helping the IT companies.
Yeah, indeed. I want to talk about NBFCs, and Naveen wanted your opinion here. While there's consensus on the street that earnings will be fine, but I guess it's about the visibility of what NBFCs would do from here. I guess it's already playing out in the stock prices, but with cost of funds only getting expensive, the entire squeeze coming in on liquidity, how is it that you would approach NBFCs right now?
So NBFCs are definitely at a very, very interesting juncture at this point in time. What we believe is that many of the NBFCs have really a robust business model, and with the kind of challenges that some of the NBFCs might face, the larger NBFCs or the high quality NBFCs are likely to see some bit of market share gains coming in the forthcoming quarter. So this space had become quite competitive in the recent past, right? So with the liquidity challenges that have emerged, many of the NBFCs which are not very strong, who have greater challenges of asset liability mismatch, are going to face pressure in terms of getting liabilities, right? So from that perspective, the likes of, let's say, a Bajaj Finance or a Mahindra and Mahindra Financial Services, or something like a Chola in South, which can tap the retail market directly. These are the companies which can gain market share, and management commentary on how they are going to weather this these headwinds is going to be very, very interesting from here on. So a bold call that people might take is that in some of these NBFCs might actually see their net interest margins rising probably 2 to 3 quarters down the line, but that will be a bold and a contrarian call at this point in time. But it might be very interesting, and there could be a huge amount of alpha which can get generated.
That's an interesting one. Suhas, wanted to get your opinion on PSU banks though. I mean, we've had 3 consecutive quarters of losses. Could Q2 finally be that turnaround quarter which everyone's waiting for when it comes to PSBs?
Not as yet. I think we'll wait until Q3.
Okay.
I think that's
at least
probably
you've got that 1 quarter
with,
visibility. But you know what? I have to take a break.
These are, yeah. Sure.
No, please finish your point.
Oh, no, I just said that, this is probably consistent with management commentary as well. Maybe we'll have to wait for second half to see, start seeing some better numbers. And I think there's been some, as the previous speaker also mentioned, I think there's been some disruption in the, so-called liability market, for NBFCs. And I think, what we hear anecdotally is, a lot of funds, moving back as deposits into the bank. So clearly the high CASA banks, which also include the, some of the PSU banks, probably stand to gain from a, liability, franchise in the coming months. So clearly, I think any improvement on numbers per se, I think probably Q3 is when we have to look at them.
Okay, still got to wait for another quarter when it comes to PSBs. But what about private banks? What about other sectors? We'll discuss and carry on the conversation, but after this very short break. Back with the earnings preview right here on ET Now. Still in conversation with our 3 experts, Suhas Harinarayan from JM Financial Institutional Securities, Gautam Dugar from Motilal Oswal Securities, and Naveen Kulkarni from Reliance Securities. But before I carry on my conversation with our 3 experts, I'm going to quickly go across to Ajay Sharma from our research desk and try and figure out what exactly are some of the other brokerages expecting from the earnings. And Ajay, Citi has come out with their earnings note on individual companies. Tell us, what is the note saying? What is Citi expecting?
Well, in terms of specific stocks where action is expected both on the downside as well as on the upside, according to Citi, some of the stocks to watch out for where actually there could be pleasant surprises. Aurobindo Pharma is one where they expect good ramp up as far as the US business is concerned, and hence the stock could be on the higher side. Similarly, HCL Tech from the IT space, according to them, is one area where deal flow will be very strong and management guidance could be actually on the higher side. Similarly, IndusInd Bank, where vehicles, the CV vehicle numbers are likely to be pretty good. On the other hand, we are also talking about Ambuja and Dalmia, 2 cement names where volume numbers expected to be good and margin pressure is not expected to be the way people are actually expecting, so could be a positive surprise. On the downside, according to Citi, Mahindra & Mahindra, L&T Finance could come under a bit of a pressure because overall vehicle the tractor financing is slightly on the lower side, and some NBFCs have been hit because of the liquidity crisis which happened for a couple of weeks. Not only that, Lupin could be on the downside. Continued pressure as far as their entire product pipeline is concerned is likely to witness, and US is also not really witnessing a big improvement. Crompton is on the downside this quarter because elevated pressure is likely to play out as far as their overall margins are concerned. And lastly, in the FMCG space, expect some amount of subdued volume, but Imami in particular is where actually volumes could be very much lower than what the street is actually expecting, and hence a negative surprise.
Okay, Ajay, thanks for those observations from Citi and some of the individual companies. But Gautam, Suhas believes that PSBs are going to still take one more quarter for them to really turn around and for the cluster as such to deliver on earnings. But what about private banks? I know all of the quarter they've only been in news for their top-level exodus, and then who's going to come back as the MD and CEO, who's going to take over the reins. But in terms of earnings purely, where do you see a surprise and a disappointment coming in?
So for private banks, as far as our estimates go, as a aggregate universe, we are expecting a very flattish profits. But that is largely on account of our expectations of 75–80% decline in ICICI Bank's profit. If I keep that aside, rest of the private bank universe for us is expected to post a healthy 19% growth. But even for corporate banks, what is more important rather than the profit number is what is happening on the balance sheet. Because these are companies where management issues are already behind, both Axis as well as ICICI. Asset quality, hopefully we have seen the worst of it. Provisioning coverage ratio has been ramped up already, and valuation seems to be in their favor, plus subsidies are doing well for ICICI Bank. So I would think that this is a very good space right now to look at, plus their CASA is pretty strong in this environment where liability is the concern. These are the banks which are going to be beneficiaries. Any which ways, I mean, a very simple trade typically in a tightening liquidity environment is always away from NBFC and towards bank. We have seen the reverse of that play out for the last 2 years. Possibly this is the time for the reverse now, away from NBFC and towards bank, especially those where the CASA is strong, liability franchise is very strong, and cost of fund relatively is lower for them. Plus their retail book has also grown pretty well over the last couple of years, even though the attention has been focused more on what was happening on the corporate book. But I think as we near the end of the asset quality issues, those are the two banks where management transition is already in place. So I would be very interested in those names right now, as far as private bank is concerned.
Naveen, wanted to get your sense on what to expect from consumption, while each of it is an individually different story, and consumption is such a large basket. But the one common theme, and especially this quarter, seems to be that if I'm paying so much for fuel, where am I going to cut costs? And that's going to be in the consumer names. Do you think a double-digit PAT growth for the entire universe is possible?
So if you look at the consumption space, so we are expecting consumer discretionary to do pretty well for this quarter. So the likes of Titan, Jubilant FoodWorks will still report pretty strong numbers in terms of earnings growth as well as headline revenue growth. The staples space, if we look at it, even that space we are expecting a double-digit earnings growth for this quarter, because see, the whole impact of input cost inflation is still not baked into this quarter, right? So more important for the consumption space will be how they take up the pricing in the forthcoming quarters, right? Whether they have the ability to pass on the input costs, and how they see the demand panning out over the next couple of quarters, and taking price hike without having an impact on the demand, right? So these are the factors that we need to watch out for. But overall, what we tend to see is that the likes of, let's say, Hindustan Lever should report pretty strong numbers in terms of volume growth as well as revenue growth, right? Marico should report decent numbers, at least in terms of revenue growth. Dabur should be reporting decent numbers in terms of revenue growth. So overall, the space should be reasonably well placed in terms of revenue growth. Margin is the area which we will be very focused upon, and the management commentary on that. So those are the key things to watch out for the FMCG space at this point in time.
Okay, so Has, very quickly on pharma then, considering IT and pharma have really had the tailwind benefit for the entire sector. But do you think earnings will be able to deliver, or again, it's going to be very selective when it comes to pharmaceuticals at large?
I think it's going to be very selective because while the sector has actually done well, not as well as IT has done, but it has done, compared to the rest of the market, it's obviously done well over a 1-year period. But I think the earnings and numbers are going to be, very, very selective in terms of how they turn out. Some companies actually don't have much of a valuation support per se, while some companies have enough valuation support, which basically means that some companies have reasonable earnings strength and some companies don't have it. So it's clearly a clearly a bottom up. There's no sectoral call, but just to give you some broad numbers, I think from a overall revenue expected, we are looking at about 7% YY growth in revenues and possibly a 6 to 7% growth in PAT. So clearly, I'm sure the internals look different, without getting into specifics of the names, but I think this is the headline number. But I would recommend one not to get carried away by the headline numbers, but to look at internally, which companies actually end up, having that kind of earnings and valuation support.
Okay, unfortunately, that's all the time we have on this edition of the Earnings Special Show. But Naveen, Suhas, Gautam, thank all three of you for taking the time out and telling us what is it that you're expecting individually from each of the sectors and some of the companies as well. Brace yourselves. Tomorrow, officially, we kickstart the earnings season with the big boy, TCS. So let's find out. It'll be for all to see what earnings actually delivers. Hopefully, we should see some bright pockets like a Bandhan Bank, case in point, being off for that matter, Z as well this Q2.